Hi folks, welcome back to Millionaire Investor channel. Today, let's look at what IPOs are and why the companies want to go from private to public. Let's first see what IPO means, and then we can look at different phases the companies have to go through in order to go public. An initial public offering refers to the process of offering shares of a private corporation to the public in a new stock issuance. Public share issuance allows a company to raise capital from public investors. So when it's private, a company is normally owned by a small number of investors that usually consist of people like you, your friends, your parents, or relatives. Once the company goes public, you are basically opening that business to be owned by a large number of people. In effect, the firm goes from being owned by just a few people to potentially tens of thousands of shareholders. To commemorate the event, most stock exchanges hold a ceremony of sorts. At the New York Stock Exchange, they present medallions certifying the day of the IPO and the company's debut as a public firm apart from ringing the bell. So why go public? Well, going public raises a lot of cash for a company. With that money, it becomes easier to increase profits, invest in infrastructure, scale, and grow the company. It's important to note that large companies can also stay private too. Staying private keeps businesses in control and on task. Another reason a company would choose to stay private is to exercise greater control over their business. By staying private, a business can remain in the hands of a few select people or families. Kiewit, Deloitte, Ernst & Young, PwC are some examples of large companies that are still private. Going public is not a simple process. From the initial meeting of all team members until the first filing, it can take at least 4 to 6 months to price an offering and begin selling shares, although the time frame can be significantly longer. The first step is to hire an investment bank who helps company raise capital by underwriting the stocks to the investors. The second step is the due diligence and regulatory filings. Registration statement with SEC, which includes information about the company's operations, finances, management, etc. The SEC investigates the disclosures to ensure that they are accurate and the company is competent to trade publicly. Once the investigation is completed successfully, the SEC sets the company's IPO date. The third step is pricing. Pricing depends on the value of the company and also affected by the success of the roadshows and the condition of the market and economy. The investment firm and the company shares their prospectus with the interested investors and set the IPO price. The fourth step is stabilization. It occurs immediately after the IPO. The underwriter creates a market for the stock after its issue. It makes sure there are enough buyers to keep the stock price at a reasonable level. It only lasts for 25 days during the quiet period. The fifth and final step of the IPO process is the transition to market competition. It starts 25 days after the IPO once the quiet period ends. The underwriters provide estimates about the company's earnings that assist investors as they transition to relying on public information about the company. 6 months after the IPO, inside investors are free to sell their shares. Now that we know what IPO is, let's see why the IPOs are so popular and when should we as investors buy the IPO stocks. There have been an increase in the IPOs in the recent years and many of them have been performing good in the stock market. Some of the successful IPOs are Facebook, Alibaba, Visa, and recently Snowflake. Should you buy IPOs when they release? There is a lot of hype in the market when an IPO releases, and most investors go with the hype and buy on day one of the IPO. What would be wise to do is to wait for the hype or the noise to calm down and let the stock play its course in the stock market for a little bit. That way, you know how the stock is performing and then make an informed decision rather than just investing and hoping for the stock to go up which most of the time would end up in disappointment. There are a few examples of IPOs which did well once they opened and did not drop. Zoom is one such example. As a seasoned investor, I would caution you and tell you 99% of the time not to buy on day one of the IPO. But if you really love and believe in the company and want to invest in it, dollar cost averaging is the safest investing strategy, along with studying the company and understanding its competitive advantage.